The final full trading week this year is coming to an end. It has been highly volatile. Wall Street will hardly take a breath a day. What to expect from a popular trading instruments today? InstaForex analysts know the answer. Trading with a high volatility, Wall Street is still overwhelmed by the doom and gloom. On Thursday, market sentiment turned sour and investors again expressed a risk aversion. The Dow Jones shed 348 points or 1.05%. The Nasdaq incurred the heaviest losses, having tumbled by 2.18%. The S&P slipped to 3,822 points, having lost 1.45%. The benchmark indexes regained fragile optimism in the New York pre-market on Friday in anticipation of the US PCE price index. The S&P500 is likely to trade in the corridor between 3,780 and 3,890 points today. The major stock indexes closed with the losses yesterday, following a three-day winning streak. The market found evidence of the healthy labor market. The U.S. Labor Department reported that initial unemployment claims rose to 216,000 last week, lower than the forecast for 222,000. Besides, the revised U.S. GDP for the third quarter came in at 3.2% on year, stronger than a 2.9% increase in the second estimate. The upbeat macroeconomic data provide the U.S. Fed with a leverage. The U.S. Central Bank reckons that the labor market should be less robust for a successful fight against inflation. However, the red-hot data does not prove a slowdown in the U.S. economy. The high-tech and the consumer sectors, sensitive to high interest rates, were the worst hurt among 11 sectors in the S&P 500. Shares of LM Research shares, the sleeper to the Micron, closed with a 8.7% fall. Micron shares dropped 3.4% and Tesla shares slumped 8.9% after the car manufacturer doubled its discounts for the cars on a sale in the United States due to concerns over waning demand. Tesla shares are on track to the worst months of the company's history, but its CEO wants to soothe their car dealers. Elon Musk said that he is not going to sell Tesla shares for about 2 years. Meta agreed to pay $725 million to settle legal auction of a data breach linked to political consultancy Cambridge Analytica. The fundamental background suggests that Wall Street will hardly enjoy a Santa Claus rally this year. The S&P 500 is set to close on Friday in the red for 3 weeks straight. The market cannot revive optimism in December, and this month the S&P is expected to fall 6.3%. December is going to be the fourth worst month over the whole history of surveys. Despite faint optimism in the pre-market, the economic data released on Friday discouraged stock investors. The U.S. durable goods orders sank 2.1% in November on month. It's the sharpest decrease since April 2020 and much steeper than the consensus of a 0.6% decline. At the same time, orders excluding transport edged up 0.2%, following a 0.1% uptick in October. Personal income rose 0.4% in November at a slower pace after a 0.7% increase in October. The actual reading is stronger than a 0.3% expected. Personal spending grew 0.1% on months, following an upwardly revised 0.9% jump and below the forecast for a 0.2% growth. The market was hit by another sell-off as their first response. However, investors need more time to absorb this mixed data. Anyway, lower personal income and weaker personal spending might cement market optimism. Today is a wonderful day for commodity currencies, but it spoiled sentiment on the US dollar. Its index shed 0.14% to trade at 104.30, and the index might close the week in the corridor between 103.80 and 104.70. The greenback is trading sideways on a Friday, having snapped its two-day growth. The index retreated to the levels of Thursday, and the US dollar perked up on Thursday amid the prospects of a further sharp rate hikes after the strong US GDP. However, a rally of oil prices and the commodity currencies pushed the greenback down. The bullish outlook for the US dollar as a safe haven asset is a big question. Traders are trying to puzzle out whether the US Fed will dare to soften its rhetoric in the face of a recession. The market is longing desperately for the dovish Fed in 2023. Until now, the aggressive Fed lured investors back to assets with fixed returns. In this context, the US dollar has appreciated nearly 9%. Meanwhile, the Canadian dollar shrugged off the gloomy mood and regained its footing intraday on Friday. The USD CAD pair slipped 0.3% to trade at about 1.3600. The trading corridor for the instrument is seen between 1.3570 and 1.3620. The loonie found support from a rise in oil prices, and Brent crude surged 1.30% to trade at $82.09 a barrel. WTI climbed 1.9%. Crude oil rallied to meet expectations of a 20% contraction in Baltic oil exports. Traders alert to Moscow, a response to the oil price cap. Russia might scale down its oil output by 5 or 7% in early 2023, and thus adjusting to the oil price cap. The news gave a helping hand to the commodity-reliant Canadian dollar. It's not the only factor to encourage the loonie. Canada's GDP did not spring any surprises. The Canadian economy inched up 0.1% in October instead of the stagnation in the flash estimate. Nevertheless, the economic output slowed down from the upgraded 0.2% growth in September. The crypto market welcomed the risk-on mood on Thursday and perked up today. Cryptocurrencies are drifting higher, having retested the lower border of the trading range. Bitcoin rebounded to 16,800. Popular tokens are trading in the green on Friday. Sam Bankman-Fried, founder of the crypto firm FTX, is leaving federal district court in Manhattan after being released on a $250 million bond package. His parents made a deal and offered the equity in their home in California. All in all, bruised by the FTX crash, the crypto market is licking its wounds. Bitcoin remains oscillating in a tighter trading range between $16,600 and $17,200. Whatever trend is unfolding in the market, and we wish you gainful trades. Have a nice weekend and see you on Monday.